Okay, so I think we should start. Is my audio clear, Sandeep? Is the audio clear?
Yes, sir, it is clear.
Okay.
Very much.
Hi, good afternoon, good evening, everyone. Welcome to our webinar on Union Budget 2023. So this is AKM Global. We are a firm of 400 people, ITR ranked for the last 7 years. Today we would be discussing about the direct and indirect tax proposals of the Union Budget 2023. I would be speaking along with my partner Sandeep Saigal, then my colleagues Manish Ishu and Ikesh Nagpal. All of us would be taking care of some respective topics. The idea is to finish it up in the next 1.5 hours, and then probably take another 15-20 to half an hour for handling questions and answers. We would be covering some main provisions. Ishu, if you can go to the next slides. We'll be talking about main proposals of the budget. There are some smaller ones, some ancillary ones, more of rationalizations measures, which we don't intend to cover. We would be in direct tax proposal, we would be taking care of corporate tax, TDS, TCS proposals, personal tax, other significant proposals, direct tax, transfer pricing, assessment and litigation. And under indirect tax, we would be talking about customs and goods and services tax. Over next slide, please. So as all of us know that India has been doing relatively well compared to all major economies, including China. So India has been bedrock of stability, both from the point of view of democracy and neutral relationships across the world, as well as strong economic conditions. In terms of macro, we are actually much better off than compared to our peers, our neighboring countries, as well as many Asian and Latin American countries. So our Honorable Finance Minister did a very good job. She presented a very well balanced budget. This is to further the growth momentum in this Amrit Kal, as it was mentioned last year. There is a global consensus that India is the place to be and would be the fastest growing economies. So I was recently, all of us know about China plus one, but a lot of people have started saying that forget China plus one. China has actually become zero, and many countries don't want to put up their supply chain in China. So India should be a clear beneficiary, and the kind of policies and the kind of tax developments which have happened recently, they have all given good impetus to this growth story. So in line with the foundation and the blueprint which was laid down in last year budget, this year also the economy has steered towards sustainable development, wide range reforms, and sound policies. There has been a massive increase in capex, and that would give a very good multiplier effect to the economy. So there was a 33% increase in the capex, and that is rightly so. So many other countries across the world are actually tightening their purses, but India is actually going ahead and actually trying to increase capex. So instead of revenue expenditure, they have actually focused on capex, which is very good. From a direct tax side, we have higher exemptions for the new tax regime for the common man. So the focus again clearly is to steer everyone to the new tax regime, which is now the default regime, and take away all the exemptions and deductions. There has been some controversy around that, and many of financial planners are saying that you are not advocating financial investments, which was done due to these tax breaks. Whereas the government has said that financial investment should not be done only for tax saving. You should do it purely because you need to diversify, and financial assets tend to give very good returns over the long term. For HNIs, the effective tax rate has reduced from 42.74 to 39%, which is a very welcome development. And optically, it is now less than 40%. So that is good. We had very high tax rate, and again, a lot of controversy was and criticism was that we don't get enough services for what we pay taxes. And unfortunately, India is a developing economy, and we need these taxes to fund social welfare measures. For HNIs, though this has been good, but there has been taxation of MLDs. They have been bought on par, like fixed deposits. Taxability of maturity benefit on high premium paying policies, that has now that would be taxable. Death is exempt, but when it is maturity benefit, that would be taxable, provided it's more than 5 lakhs, the premium amount. And then on reinvestment of capital gains into properties, which has been exempt, there the restriction has come that it would be exempt only up to 10 crores, because the idea was to provide boost to housing, and for these very high valued houses, the government does not seem to be very keen to provide this benefit. And as we have seen, luxury market has seen some very strong growth over the last few months. In fact, right after COVID, it has been very good. Startups have been given extended time limit for claiming exemption as well as for setting losses, but one of the provisions which has been troubling them for years has been angel tax. Now that has been become applicable also on foreign investments, which is actually very. I would say that that's a regressive move, and that would definitely impact funding, especially in this environment where many of the startups are actually reeling under fund crisis as well as layoffs. So I think this was not the right time to do this, because our Indian startups have actually done extremely well, and have the entire world looks up to the innovation coming out of Indian startups. For individuals sending money abroad for investment in shares or for travel, there has been a big increase in TCS from 5% to 20%. This will definitely impact cash flows and would then demand for these expenditures. So again, I think when this was introduced, the idea was to keep a track and to trace these investments, which was earlier wasn't being there. But I think going from 5 to 20% is again a very regressive move, and I think that's something which could have been avoided. You can still track all these expenditures, because 5 to 20 would result in cash flow issues. From the custom standpoint, again, the government is very clearly intent to promote domestic manufacturing and with a special focus on green mobility. So we are going to cover all of this, and my colleagues would be starting off talking about all these in detail, and we have tried to cover all the major provisions. But of course, if there is anything which comes to your mind, we would be happy to answer that in the question answers round. So over to you, Sandeep, for taking it forward. Thank you.
Okay, thank you, sir.